Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let these handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Now here are your hosts, Russ Morgan and Joey Murray.
Have you ever had the thought, I really am not saving enough for the future? And at the same time, you're sitting down to write an enormous check to the IRS every single year for $100,000, $250,000, $500,000 in taxes? Guess what? We just found the money that you should be saving, and it's been under your nose the entire time. Go to freetaxwebinar.wealthwithoutwallstreet.com and learn how the wealthy are paying less in taxes. You can implement these strategies so that the next check you write will be to your financial future and not to the IRS. Welcome. This is the Wealth Without Wall Street podcast. As always, your host, Joey, the Italian Stallion Murray, joined with Russ, the Idea Guy Morgan. And Russ, I hope you have some stout ideas today because there is a train barreling down on us right now. It's coming our way.
There is a train, and we usually have a lot of fun on this show. We're constantly making fun of each other. Today, it's going to be a little more serious talk. It's straight talk with the Stallion and the Idea Guy today because we're going to be talking about taxes, which is something that nobody likes to talk about, especially after I just finished paying a six-figure bill before October 15th, and I'm sure as you are, you're like, yeah, been doing that for a while. It's just never any fun. I don't like doing it, but it's important for us to understand what's happening so we'll know what to do. And for you and I, we've been looking at this tax train for a while, and there's a book out there that we kind of refer back to from time to time. It's called The Power of Zero.
Right, David McKnight.
Yep, and its message is how do we, when we get to quote-unquote retirement, how can we live and earn an income, not reduce our lifestyle, but still be in a 0% tax rate? That
is great news. Are we going to talk about that today?
We're going to talk about
how we get there.
We're going to talk about how you can get there, but before we do that, we got to just talk about the bad stuff. Unfortunately, we got to talk about what's going to keep us from getting there and why it's imperative for us to pursue the mission to get to that because of what's potentially looming out there for us.
Well, we all want certainty in retirement. We all want to keep more of the money that we're making. And if you were standing on the tracks and a train was coming, I didn't come and push you out of the way. I mean, think about that. That's what we're going to do today. This episode and the video that we're going to show, we're going to use that video November 29th. For those of you that are in the Birmingham area or around, we have a very exclusive showing. We're going to rent out a movie theater to show the tax train is coming video. This is a documentary that was done by David McKnight. We want to make sure you get there. So go on the show notes and reserve your ticket. There's only going to be a handful of those available. Make sure and do that. For those of you that are listening to this after that date, you can also go to the show notes and get a replay. You can actually buy the DVD through our show notes.
Yeah,
okay?
You're going to be able to go. It's taxtrain.wealthwithoutwallstreet.com. Or you can go to the show notes and we'll have that link on there. But if you go to taxtrain.wealthwithoutwallstreet.com, you're going to be able to sign up and actually be able to get connected to come to the movie. I know you said video. I mean, that's kind of part of our age, right? Everything's a video. But also, if you are after the fact and you're listening to this or you can't come because you're across the country and you're like, I don't know if it's worth traveling all the way to Birmingham to come see the Stallion, then we're going to give you an option to be able to actually buy the DVD, and we're going to we'll mail that out to you. But here's a key, Stallion. As you talked about, if somebody was standing on the tracks and you didn't come push them, that would be a bad thing. And I believe that to be true. That's why I'm willing for us to talk about this today, because I feel like ultimately we are going to do a service for you as you're listening to this. Even though it's just not a whole lot of fun. In the movie, because you and I have had a chance to preview this documentary.
That's right.
We got early access to it. And one of the things that really stood out to me, he used this cartoon from our youth, which was the Roadrunner and Wile E. Coyote.
Oh, I crush that thing every Saturday.
Yeah. I mean, who didn't? Looney Tunes, right?
Yeah, come on.
So he shows the coyote, who's obviously trying to find a way to kill the Roadrunner for the thousandth time. He's building this bomb in his little shed. And while he's in his little shed, the Roadrunner pushes him on top of the tracks. And all of a sudden, here comes the train, right? The coyote hears the train coming, looks out his window. What does he do?
You would think he would get out and run.
No, he doesn't, though, right? Because he's too busy. He's got something to do. Very similar to us. We got a job to do. We got a business to run. I'm too busy to think about these things you guys are talking about. I got to keep going what I'm doing. And so Wile E. Coyote, like us, reaches over and pulls down the shade as if that was going to make the train go away.
If I don't see it, it never happened.
And so today we're going to help you see it, right? We're going to
That's
hold
right.
your arm. We're going to keep you from pulling down the shade. As long as you're listening to the show, hopefully it's going to be exciting enough for you to stay with us and continue on. But we're going to share with you some pretty scary facts, but also we're going to share with you a solution that David McKnight shares in his book, The Power of Zero, and through this documentary. There is a path. And by the way, shocking that it's outside of Wall Street for the most part.
That's right.
It's using tools that we're already familiar with and we're already doing.
Okay, so let's get down to this. There is a problem. Many of you are probably thinking this right now. I don't really know what the problem is, but I can tell there's something not quite right. So we're going to uncover what is the problem in our country, and it is this monster that we've created, right? Overspending in our government. This is an absolute travesty that we have allowed to grow and grow and grow year after year. And our country is almost at this point of where we're entitled to free education, to free healthcare, to free fill in the blank. And nobody is stopping and saying, there is no free lunch. Am I right?
You got to say, and you know this too, right? You know intuitively that something's wrong, because you know that we can't pay for medical care for the whole world. We can't educate our whole U.S. system. We can't provide for Social Security and all these other benefits, which, by the way, my parents are using, and your parents are probably using, and somebody you know, probably 50 people you know are using, and they're good people. It's a bad thing, but we can't have all these things for free. They have major cost. Our country is at $21 trillion in debt.
That's with a T, right?
We have like $200 trillion in unfunded liabilities, meaning promises that we've made to pay for things that are to come, right? So
right, not on the books today, but in the future.
Yeah, that we've already promised. Like you've already said, Russ, I'm going to buy your lunch for the rest of your life. And I'm holding you to it.
I did not say that, by the way.
Well, that's what an unfunded liability would be.
Okay.
But here's the key to this thing is that, we're not going to solve the problem. And by the way, this is not a political rant, because we just got finished with the midterm elections. It's 2018, and there's lots of people out there that are happy. Some of them are sad. And here's my little thought to this process. If all the Democratic politicians and all the Republican politicians were stranded on a desert island, do you know who would win, Stallion?
I give up because they piss me off. I'll be honest.
America wins. The reality is that that group of people are robbing us blind, and we're
cheering them on.
We're cheering them on. We can't help ourselves.
It's a we versus them, and it's just a joke. I mean, I was sick to my stomach watching that stuff.
Yeah.
At the end of the day, we are all losing because they have consistently separated us on issues and things that just allow them to spend and spend and spend. It doesn't matter who's in office. It's just all the same.
The spending
deal.
continues. It doesn't matter who's in office. And this is the issue that's causing this tax train. It's because the former Comptroller General, you may have heard us say this on our show before, David Walker, was basically the CPA for the United States for about 10 years. He came out and said, taxes are going to have to double, Stallion.
That's like times 2.
Yes.
Okay.
And the 4-letter word that tells you why is math. And he's looking at this. He says there's no other way. And they evaluate this in this documentary. They go through and they talk about Medicare. They talk about the Social Security. They talk about education. They talk about healthcare. They go through all of these things, and what's breaking down the math part is that we have too much expenses, not enough revenue. We have too many people on the take, not enough people paying, and the only option for them is to increase revenue, meaning increase taxes. And considering that we are at an all-time low, this is action that we should take notice of and say, hey, here's a chance to buy this dress on sale.
Like Black Friday.
Exactly.
Right? But I don't know that people really believe what you just said. That right now taxes are at an all-time low. I mean, it feels like we're taxed out the ears right now.
Well, yeah, because you think about all the stuff we're paying, we're probably paying over 50%. But let me give you some statistics down. You want some numbers here?
But we just got tax cuts, right?
Yeah. If you own a business with over 500 people working for you, yes, you benefited. Everybody else, literally for everything they gave you, they took something else away. If you don't believe that, we've talked about it on here, the personal exemptions, which is something a lot of people were taking advantage of. For every person in your household, you get that $4,050 exemption. And for you and me, that's a lot. That was 6.
Yeah, I'm
that's
still working on
25K.
that number, yeah.
Gone. Doesn't exist. We used to be able to deduct our state and local taxes. We kind of refer to that as SALT. We could take that against our federal taxes. So basically we didn't end up paying double taxes on it. Yeah, now it's capped at $10,000. So the rest of that, gone. I go on and on and on. By the way, if you want to know more about that, go to our tax webinar. We did a tax webinar on this.
Yeah, free tax webinar.wealthwithoutwallstreet.com. We tried to make it as long as possible. We'll also put the link in the show notes, but download that. We go through all the different things that you have lost and the very few that you gained, but we have to be strategic, and so we go into more strategies that you should be using to limit that. So that's for income today.
Yeah, that's income today, which is an issue because I will say that our objective is how do we get to passive income? How do we get to a point to where we don't have to actively go to work unless we want to? Which, by the way, I love what we do, Joey. There's a few things in our job I don't like, and I'm always trying to figure out a way to get out of those, even though I can all the time. But if you don't like what you're doing, if you don't like your business, you want to get to passive income, and we need to be in a position where our tax bracket is 0 so we get to keep more of the money. And that's the point of this, is that if taxes are going to double, which David Walker is saying they're going to, right? Yeah. He's the one putting it on the wall, not me and you, saying, I think they're going to double. Then we need to have some strategies to get out.
And it's not that far-fetched for what he's saying, right? Because we kind of have a short memory, but the tax rates in the 70s and 80s, what were they? 1980, it was 70% was the top tax rate.
70%?
Yeah. So we're at 30s.
Most people if you're listening to this right now, I'm betting you did not believe the top tax rate was at 70% just 30-something years ago.
Yeah, 1980 was a great year. That's when I was born. I mean, I added a lot of value to this world.
They needed all those dollars.
I mean, good night. The tax rate was 70%.
70%.
And that was for people that made over how much?
Oh, it was probably like millions of dollars.
Try 215,000.
So for everybody who made $215,000 or more, they started paying 70% on those dollars?
I like to think of it as they got to keep 30%.
Man,
that's defeating.
Are you running for office at this point? I like the way you spun that a little bit.
I mean, good night. But so my point is, it's not what he's saying we think is, ridiculous. Like, how could they possibly double? But it's not in our too distant
during
past.
our lifetimes,
exactly,
the tax rate was twice what it is today,
easily.
And the fact is that our deficits, our debts, are so much greater than they were at that time. It's not far-fetched. I mean, here's the thing that most people don't realize is that in our country's history, the top tax rate was 94%. Based upon what the Stallion likes to look at, being the glass half full or partial full in this scenario, is that you got to keep 6 cents of every dollar that you made if you made over $200,000. Now, I sit there and I look at some of these things and I go, man, if we're in that sort of scenario, how is that going to motivate us as entrepreneurs to go create?
No,
it won't.
You're going to stop.
Yeah, our former president Ronald Reagan actually was an actor during that time frame when tax rates were in the 90 percentile, and in his memoirs he talked about only doing 2 movies a year because he got paid about $100,000 per movie. So he knew he quit. I mean, he was one of the more famous actors at that time, but he would only do 2 movies. Why? Because any other movie that he did and got paid for, he didn't get to keep. So why do it? Why not just ride off in the sunset for the
totally
other 6 months?
Unmotivated at that point. But let's talk about another thing. For those of you that think, okay, this is ridiculous, 70, 80, 90% tax rate, it'll never happen. Here's the really cool shell game that goes on right now as we speak. I'm just using 2018 tax cuts as an example. Even though the actual tax bracket may not say 70, 80, 90%, what if we start calling things different names? Like, how about for the Affordable Care Act? What do they call it? Do they call that a Medicare or they call it a surcharge?
Yeah.
Not a tax, but how did it get through the office?
In order to pass it, they literally, when they took it to court, right, because they were fighting it, and they literally were able to say, no, it's not health insurance. It's literally a tax.
Right. So now we pay 3.8% surcharge.
Yeah.
Well, doesn't that just reduce the amount of money we get to keep?
Yeah. Well,
so it's a tax.
It's a tax. I don't know if it was the last episode or the one before, we talked about how inflation is another type of tax. Well, we have this pass-through taxes, usage taxes. Every time we go to fill up the car, the SUV, the Avi, then we're going to literally be paying taxes that are associated for the use of the roads. It's been built into the cost of the gallon of gasoline. We have so many taxes. It continues to go on. Words are important, though. And I see that because here's the things. What's problem standing in our way? Well, a big problem is this sleeping giant that we have, this looming tax burden.
Yeah.
But the problem is that we're also putting money, unfortunately, into things that is postponing the taxation of those dollars.
Taxation and the tax calculation.
Right.
That's the critical question, or critical thing I want to point out, is that we've been told that it's good for us to defer taxes. In fact, if you think about that word, it just kind of makes you feel good.
It does.
You know?
It's got like a little warm and fuzzy on it.
Oh, I get to defer? Man, that sounds awesome.
Who doesn't want to defer?
But if I say
postpone,
it has a little bit of different ring, doesn't it?
Postpone means I'm going to have to do that.
It's
later.
inevitable,
I'm going
right?
to do that one, yeah.
I got to deal with it at some point. Defer just doesn't feel that, it feels a lot better. But that's what we've been bought into with all these qualified plans that the government created, shocker, and they get to control the calculation of those future taxes.
So they say if you literally were putting money into your 401k, and instead of them calling it a tax deferral plan, I want you to really just think through this question. If it was not called a tax deferral plan, it was called a tax postponement plan, would that change your mind?
How active would you be at putting money in it?
I think you would probably think about it differently, right?
Right.
I mean, that word would make you think about it differently. The same way as like, oh, I want the government to pay for this. If you change the word government to, I want the taxpayer to pay for this. And let's just, really get honest. Just look, whatever your neighbor's name is. So one of my neighbor's name is Ron. So instead of saying, I want the government to pay for my road improvement, I want Ron to pay for my road improvement. Now, unless you hate Ron, which I don't hate Ron. Ron's really nice. He actually improves our little gravel road all the time. He's out there working. He's like 80. I love that guy. I don't want Ron to have to pay for something more. But that's what we do. We substitute the word Ron for government, and then we're like, oh, well, surely they're holding like car washes or something. They're building something that's worth something, and they're making money, and that's how they're paying for all these things.
No, not going to happen. It's you and me. We are the revenue source for all the things that we're talking about. And you know what? At the end of the day, Russ, shouldn't we be able to keep more of the money that we make? I mean, that's what we're really talking about today. And you and I are right there with everybody else. So we're trying to consistently build strategies that put us in a position where we are in more control.
I want it. I could tell you, I want that money back. I just wrote the check for. I want it back, Stallion. I am sick and tired of writing those kind of checks. Hey, I love our country. I realize there's things that I use and I want to pay for them. I'm not looking to be a freeloader. Even though I pay every single day for these kids around me to go to these public schools through my property taxes, I don't send my kid to those public schools. I didn't do that. We homeschool.
That's right.
So, I mean, I realize not everybody can. So I don't mind helping out in different areas, especially in areas that I use. But I think that we've got to a point where I know the rates are going way, way up. And I'm going to be honest with you. I'm going to find every way I can legally to stop paying all this excess in taxes.
Okay. So this is a great point. At this point, if you've made it this long, you may be depressed. Okay. You may be, again, have pulled off the side of the road. You got a couple tears, whatever. But here's the deal. There is a way out. And in fact, again, I want to make another plug for the movie that we're going to air. You want to come watch this with us. You want to either download it after the fact or request a copy of it after the fact. But there's a process that we need to follow, Russ. Let's walk that through right now.
All right. So during this movie, he lays out very clearly the problem. And we've just touched on a few of the points. And I know you're probably pissed off like I am. And be perfectly honest with you, I want you to be pissed off. I want you to say, yeah, this is an issue. And I don't want you to pull down the shade. I want you to keep the shade wide open. I want you to see that tax train coming. But we're going to give you the ability to get off the tracks. And he lays out a very simple plan, and our monies are broken up into 3 different tax areas. They're taxable, there's deferred tax or tax postponement, right? And some people are going to say tax deferral, but I'm going to quit saying that word. I'm going to say deferred tax or postponement plans. And lastly, are tax-free, dollars that literally we don't have to pay taxes on and don't go into the calculation to make other things taxable. So, Joey, in step 1, he has a strategy. He says, okay, this is how much money you need to have in taxable plans. What is that?
Yeah, so everybody needs a good, easy math, right? So save up to 6 months in a taxable account. And now, he says taxable. You and I, of course, we've talked about the opportunity fund by using your life insurance policy that's created for cash value, the ones we always talk about on the show. That is a great place to store this 6 months of reserves. Your monthly expenses, 6 months of those, set those aside.
Well, and he says, I mean, again, he knows that we need liquidity. And here's one of the things. So some economists that we've had on the show before, Bob Murphy, one of them,
right?
He's a big advocate for you having at least 30 days of cash on hand. Because if things go crazy and they shut down the money supply, you want to have dollar bills. You want to have access to it. So again, I'm not telling you to do that because I'm not encouraging people to come to your house and try to come find it. By the way, I got guns at my place. So just beware. But here's the thing. I do think that we need to have liquid cash, but there's a second part to this. So there's people, and you may be one of them, who have followed the American dream of deferring as much of your taxes as possible by putting money in 401ks or IRAs. And not just us, but David McKnight is on the plan of saying, we got to get out of those plans.
Right.
We got to start moving money from deferred tax plans into either Roth IRAs or into life insurance. So his thing is...
All right, so this is step 2.
Yeah,
we moved from step 1, step 2.
Yeah, he's saying if you're going to have any money in those plans, it needs to only be just enough to when you got to retirement, the money that the government required you to take out of, those accounts are less than your standard deduction.
Okay, so you just said a lot there. First of all, required minimum distributions, RMDs, kicking at 70 and a half.
Right? That's when you're forced to take money out.
You're forced to take money out. And you're saying at that point, you should not have more in those accounts that you'd have to take out more than your standard deduction.
Yeah, so for instance, today, a married couple standard deduction is $24,000. That's been bumped up pretty big, right? So if I did the calculation on my account value right now at 70 and a half, what my required distribution would be, I would not want to have more than $24,000 to have to be kicked out to me, because then that money would be subject to taxation. Because if I got $24,000 and I had a deduction of $24,000, I'm still in the 0% bracket. You see where he's going with this?
That's right. Now, sidebar, and I don't want to get us too far off the rabbit trail here, but you and I don't know what the standard deduction will be when you and I are 70 and a half. So there's still...
Or if there's going to be a standard deduction.
Exactly. So there's a level of, hey, we can't really help you on that deal, but just kind of reiterating what he said.
Which, by the way, that's the thing that will go away first. So we're going to do away with standard deductions. We're going to do away with mortgage home interest. We're going to do away with some of the business deductions that we have, because they're going to do everything they can to act as if the tax rates are staying the same.
That's right.
Because the reason we're at 37% is not because the government is bringing in less tax revenue.
That's right.
Tax revenue has been going up at 20-25% and constantly. All they've done is they've just taken away different deductions. Where you used to be able to buy a car and you could write off the car interest. You have a credit card interest. There was all sort of different things that you could deduct. I mean, last year alone, we could deduct 100% of our meals for our employees. Now we can only deduct 50.
Yeah.
These are the things they do away with. And so
that's the shell game.
Yeah. Unless you're seeing those things, you don't realize that, they're just they're robbing Peter to pay Paul. Well, when those things are gone, Joey, when those things are gone, then there's nothing else to take away. They got to go to, okay, by the way, here's what we're doing, guys. Tax rate's 50%. Tax rate 65%.
That's right. So, all right. So somebody that's hearing this saying, well, crap. I mean, now I don't even have the RMD thing to work with. Maybe they do away with standard deductions. What else could they do right now? We talked about Roths, right?
Well, if you have, again, we're not giving you financial advice. We're going to tell you to go seek someone, because, by the way, we're not going to deal with these type of plans anyway. I don't believe the Roth deal is super secure. Because, again, it was created by the government, and they can change the rules, and they always do. If you don't believe me, go look at the list of laws that are created every single year.
Yeah.
And the adjustments to those laws. But David McKnight's plan for you is to say, if you have a 401k, IRA, money that hasn't been taxed yet, you can start converting those into Roths, paying the tax today.
Whoa, Russ, are you talking about paying a bunch of taxes today? Extra taxes that I didn't want to have to pay?
I am telling you to do that. And I'm telling you, obviously, you need to seek accountants. You need to have other advisors that are knowledgeable in this area. I mean, this is something that you and I are helping consult on these days. We're working with other. I mean, that's the reason why we've brought in tax attorneys into our offices and are literally working side by side with our clients to reduce their tax burden. And there's things that we can do to help offset us paying those taxes. So don't just go cash those things in without doing some other planning, because there's some serious things that can help you offset taxes. But yes, it is like literally, if I'm
get it on sale.
If I know I'm going to pay $1 in the future and I can pay 60 cents or 50 cents today, why wouldn't I do it?
Right. Yeah. So we got to do that. We got to take advantage of that. Again, Russ and I, we don't do anything with Wall Street, so don't call us about those things. But just let you know, number one, we got to go back through this real quick. Number one, save 6 months of expenses in a taxable account. In some cases, that's savings account, money market, so on, or in your properly structured whole life policy contract. We can help you with that. 2, make sure you take care of getting either reducing the amount that you have in these tax qualified plans that are going to be deferred to get below the RMD level of the standard deduction, or start converting those to Roths so that you can pay the tax at a discount today. All right, Russ, what's number 3?
All right. So again, these are David McKnight's rules, and we're just sharing you sharing with you what we've learned, and I believe a lot of what he's saying here has lots of valid information. The third spot is we've got to get our money into tax-free vehicles that won't create provisional income for us in the future. And the only two places that doesn't have any sort of provisional income, which I'm going to talk about what that means in just a second, is Roth IRAs,
Right.
and cash value life insurance.
Now, which one of those things you think we're going to want to talk about?
We're going to spend time on cash value life insurance. I mean, because
That's right.
Again, it's private. I just like the privatized part of it. I like the fact that the government can't control my life insurance policy. I like the fact that it's credit approved. I like the fact that I can access it. I don't have to wait to this magic 59.5 to touch it. But I do like the fact that Roth IRAs in their current state, if they're not adjusted, gives you the ability at 59.5 to not have to pay taxes on it. And clearly, you listening to this probably cannot contribute to a Roth IRA, nor can I. But you may have monies that are in IRAs that you can go ahead and pay the tax on and transfer them into this.
That's right.
And there's lots of reasons why that would be beneficial to you, because if those dollars, when you start taking dollars out either of life insurance or out of Roth IRAs in retirement, not only are they not taxable dollars, so they're tax-free, but it doesn't increase your provisional income. So tell them what provisional income is, because I keep talking about it. And I'm like, what's that?
Okay. So provisional income, and I may not be 100% true on the actual explanation here, so bear with me, is the calculation that the government would say, once you go past a certain income level, they're going to tax other benefits based on that. So for right now, we're talking about Social Security. So you start receiving Social Security benefits. If you exceed $32,000, this is today, as a single person, or $44,000 as a married couple or family, then you now have to pay 85%, or 85% of your Social Security benefit is taxable. Whereas if you're below that, I believe, and don't quote me on that, it's only 50% of it. So now you've, again, kept more of the money that you made, or in this case, received in terms of a benefit and Social Security.
Yeah. So, I mean, the main part of provisional income is to determine how much of your Social Security benefits would be subject to taxation or not. And so what goes into provisional income? Well, it's anything but tax-free assets. So if you have a 401k, that's going to count toward provisional income. If you have interest or dividends on savings accounts, CDs, money market accounts, mutual funds, stocks, anything of those nature, then it's going to kick off provisional income. That's the reason why he said in step one to have 6 months or less, because for most people, that's not going to kick off enough interest or enough dividends that's going to ratchet up your provisional income. Now, I will tell you right off the bat, if you're 50 years old or under, don't even worry about that calculation, because I am praying right now for Social Security not to exist for you and me. And you're probably like, Russ, why? Why would you say that? And the answer is, well, let me make a statement first. I think I am making a statement. I'll make another one. Joey, in 1912, before the IRS was enacted in 1913, Congress controlled 94 or 95% of the budget, meaning they got to determine out of the money, that $130,000 that we're spending, your family example again, they got to control 94% of it. So they can make some tough choices.
Sure, they can make changes. Yeah.
I mean, I'm not saying that they would, and I'm not saying they're going to be easy, but they could make some tough choices. Do you know how much of that budget now they control?
I know it's a lower percentage.
It's like 30%. Literally. So if you're making 30 and you're spending 130, and you can only control, what's the math on that? Roughly 40,000?
Yeah.
It doesn't matter. They literally could say, okay, we're going to cut spending on everything that they can control. They cut off 30%. They cut off 40,000. They're still spending 90,000 and bringing in 30.
That's just...
It doesn't work. That's why there's a train coming. That's why income has to double, because even if they wanted to. So what I'm trying to say here, if for Social Security, and this is not again, I have no interest in politics, but this is, and no politician would ever make this happen. I hope that they would stop for you and me offering the benefit. we're going to have to pay for Social Security and Medicare for everybody who's on it because
right.
it represents the majority of all the money that they live on. If literally they do away with it, there's going to be people dying in the streets all over the place.
Well, it was always a Ponzi scheme.
It's always
and it will continue to be.
Yes.
Right. But so that's probably a whole nother episode.
Sorry.
Russ.
I know I derailed us on that.
So let's wrap this thing up here. Okay. At the end of the day, there's steps you can take to step out of the way of this train. The first is come watch the movie with us. November 29th. It's there's a movie theater here in Vestavia. We'll have all the details in the show notes. Go online on our show notes and sign up for that.
Or you can go directly to the link. It's taxtrain.wealthwithoutwallstreet.com.
Okay. Yeah, I forgot that part. If you're listening to this after November 29th, 2018, we will have a link where you can purchase the DVD. You owe it to yourself to get your head out of the sand and learn this stuff so you'll know what to do.
By the way, you can go to that same link, taxtrain.wealthwithoutwallstreet.com, and get access to be able to either pre-purchase if the DVDs aren't available yet, or to order it from us, and we're happy to send you a copy.
I mean, I should have just had you tell all this.
No,
okay?
I like this part. It's like you set me up and I knock them down.
And again, we want to make sure if you missed our tax webinar, that's at freetaxwebinar.wealthwithoutwallstreet.com. Make sure you get that. The book, Power of Zero by David McKnight, we'll have a link on our show notes for that. You can purchase it there. At the end of the day, we are looking for you to keep more of the money you made, to maximize and optimize your passive income in retirement. And to be quite honest with you, we want you to secede from this casino that we got going on in the government right now. Like where you can take action to not put yourself in the way of this train, take action. We want you to have more control and to have clarity in this passive income time instead of worrying like so many other people are going to be caught with no other options.
Yeah, I definitely know as entrepreneurs, you like me love the fact that you get to do things, make things happen. You're a take action type of person. I don't want to be in the later years of my life depending on others. I like the fact that others would take care of me. Like I want my children to be around and to help, but I don't want them having to take care of me because I have no money, because it's all gone. I want to be in a control position. And I just think that this is something that is not beautiful to talk about. Nobody likes to talk about this. And I mean, we're going to have some fun, laughing podcasts after this. But this is the one that maybe needs to be shared the most with the people that you know, because this is the one that most people are sitting on the tracks, working head down in their shed, and they've just pulled the shade and said, I'm just postponing.
Right. So thank you for sticking with us this long. Hope it was helpful information, and we look forward to catching you on the next show.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.